Hi, we are from Group 2, so we will present about non-current asset held for sale. So stay tuned.
Hi, I am Anur. I will talk about the first part of the presentation, which are the terms and the classification of non-current asset held for sale and disposal group. Non-current asset held for sale is non-current asset that is no longer being used by the company to generate profit. If company plans to sell some assets and stop certain activities or stop business in certain areas, stakeholders that involved in the company should know about it. IFRS 5 need company to present the non-current asset held for sale because they are no longer classified as non-current asset. Another term is disposal group. This is when the company decides to dispose one department of the company. All assets and liabilities are combined as a disposal group because the company disposes them on a single transaction. However, they will be presented differently in the financial statement. Moving on to the next slide, how to classify non-current asset as held for sale. Firstly, the carrying amount of the non-current asset can be recovered principally through the sale of the asset rather than through continuing use. So, if companies sell only part of the asset can be considered as non-current asset held for sale because they are not recovered totally from the sale. Secondly, the non-current asset must be made available for immediate sale and the sale is highly probable. These are the criteria that means the sale is highly probable. First, the management must be certain and committed to sell the asset. The asset also must be actively marketed with a price reasonable to the asset's current fair value. An active program to find buyer is actively done by the management. The sale also must be expected within 1 year, with certain exceptions, and the plan must be not be significantly changed or withdrawn with the action of the company to complete the sale. So move on to the example. For 1A, an entity intends to dispose of its office building and the time taken to vacate in 2 months. So the answer is the office building can be classified as non-current asset held for sale under IFRS 5. This is because the office building meet the factor of being non-current asset held for sale, which is the sale of the office building is expected within 12 months. For example 1B, an entity has found a buyer with a firm commitment to buy its office building. However, the entity intends to use the office building until the completion of the construction of its new building. So the answer is the office building can be classified as non-current asset held for sale because the office building does not available for immediate sale since the entity still use the office building. The entity may classify the office building as held for sale once the new building is ready to use by them. For example 1C, an entity is committed to a plan to sell its building and lease back the building on finance lease. So the answer is the office building can be classified as non-current asset held for sale because the building is not being sold totally to the buyer but just being leased to the lessee. And finance lease is considered as loan agreement which the entity will receive payment annually from the lessee with the interest. Next, example 1D, an entity has some equipment that has recently been retained by the lessee and the entity has not decided whether to sell or lease them. So the answer is the equipment can't be classified as non-current asset held for sale because they didn't meet the condition of being non-current asset held for sale, which the entity has not made a decision to sell the asset. They didn't settle and commit to a plan for selling the asset. For example 1E, the entity commits to dispose of its factory including unfulfilled order from customer. So the answer is this can be classified as non-current asset held for sale under IFRS 5 because the entity disposed the disposal group that consists of the factory and the unfulfilled order from customer. They are also made readily available for immediate sale and highly probable for being so. Lastly, for example 1F, the entity wants to fulfill all the present customer orders. The factory will only be transferred after the entity ceases operating the factory. So the answer is this can be classified as non-current asset held for sale because the factory does not available for immediate sale since the entity determines the time of the asset disposal and only will be transferred after certain condition.
Next, I would be talking about extension of the 1 year period, which means that even after the period of 1 year, the asset can still be held for sale if and only if the criteria are met, which are the delay of sale is caused by events or circumstances beyond the entity's control, the entity is still committed to sell the asset, and the buyer has set certain conditions that causes the entity to require more time to hold it for sale. Examples of changes in circumstances that can be considered to extend is the asset is being actively marketed at a reasonable price, the sale is highly probable, which means it is very possible that they can sell the asset, there is management commitment to a plan to sell. So next, I will be talking about the first event, which is connected to example 2 that I will be discussing later. As for the first event, at the date of commitment to sell the asset, the entity expects others, which is not the buyer, to impose conditions on this transfer of the asset, and actions to respond to these conditions can only be undertaken after a firm purchase commitment, and it is highly probable. A firm purchase commitment involves a legally enforceable agreement with an unrelated party whereby the agreement includes all significant terms such as price, timing, and penalty for non-performance. So, which means that they need a legal agreement in order to ensure the purchase commitment. Without a legal agreement, it shall not be acceptable to extend the period to classify it as held for sale. So, as for example 2, an entity commits to sell its building and the buyer needs to obtain a bank loan to buy the building. The legal procedures include the registration of the transfer with the land office will take more than a year. The regulatory procedures cannot be initiated until a buyer has made a firm commitment. So this is one of the legal agreements that is considered to be a criteria. So as for the answer, the building can be classified as held for sale because the actions to transfer the asset will take more than a year and it cannot be proceeded much earlier until the buyer gets the bank loan, a firm purchase commitment. So this is beyond the entity's control. So it is allowable. The buyer also needs to deal with the bank and make a legally enforceable agreement for the firm purchase commitment that includes all significant terms. So as for this, the delay is acceptable for it to be committed to sell. Next is example 3. The entity has made a commitment to sell a building in its present condition and classifies it as held for sale. The buyer makes a firm purchase commitment, but on inspection of the building, the buyer requests the seller to make good some environmental damage to the building which was not previously known. Rectification work, which is highly probable to be done satisfactorily, will extend the sale period beyond 1 year. So this is also beyond the control of the entity because the buyer is requesting the seller to improve the building. So because of that, it is allowable and the building can be classified as held for sale because the buyer requests the seller to make good of the environmental damage, and because of the rectification work, it requires the period to be extended. Therefore, it is acceptable. Next is example 4a. An entity made a firm commitment to sell its office block at a reasonable price. During the 1 year period, there was a glut of office space and prices dropped. The entity reduced the asking price to a reasonable amount. So it is also classified as held for sale because the entity had a commitment to sell the office block and the selling price is reasonable. Reasonable is one of the criteria of extension of 1 year period. Therefore, it is acceptable as the circumstances is beyond the entity's control and at the same time, the entity is still committed to sell the office block. So continuing to 4a, which is 4b, in the second year, the prices of office blocks dropped further, but the seller believed that the market condition would improve and did not reduce the asking price, which was more than its current fair value. So in this, the entity is actually in control of the prices, so which makes it not allowable to be classified as held for sale, and it is actually should be treated under MFRS 116. This is because the price of the building is more than the market value and it is sold not at a reasonable price. Therefore, it is not acceptable for them to extend the current asset held for sale.
Good afternoon and hello everyone. My name is Alia Anisha and I will be explaining about the measurement of non-current assets held for sale. So non-current assets that are classified as held for sale will be measured at the lower of carrying amount and fair value less cost to sell. But if the carrying amount is lower compared to the fair value less cost to sell, no adjustment need to be made. However, if the carrying amount exceeds fair value less cost to sell, impairment need to be made and impairment loss should be recognized in P&L. Reversal of impairment also can be made, but it cannot exceed the amount that have been impaired before, and the amount should be recognized as gain on impairment in P&L. Next, I will be explaining about example 7. So, on 31st July X4, an entity committed to dispose a plant. The current value of the plant was 500,000 and the current market price of the plant is 600,000. But it would cost the entity 20,000 to dispose the plant. If the entity were to continue to use the asset, it will enjoy economic benefits estimated at 40,000. So as the plant is classified as held for sale, therefore it will be measured at lower of carrying amount and fair value less cost to sell. So the carrying amount is 500,000 and the fair value less cost to sell is 580,000. Therefore, the non-current asset held for sale will be measured at 500,000. So next, I will be explaining about example 8. So on 1st December X4, a plant of Ray had a carrying value of 250,000, but its carrying value was remeasured to 245,000. On classification as held for sale, the fair value less cost to sell was 230,000. On 1st March X5, the fair value less cost to sell was 240,000 and 255,000. So on 1st December X4, the carrying amount of the plant is 250,000 and the adjusted carrying amount is 245,000 and the fair value less cost to sell is 230,000. The plant need to be measured at the lower amount, and the amount of the adjusted carrying amount, which is 245,000, is higher compared to the fair value less cost to sell, which is only 230,000. Therefore, impairment need to be made to make sure the carrying amount is not overvalued. So the difference between the adjusted carrying amount and fair value less cost to sell is 15,000. So we need to debit impairment expense by 15,000 and credit accumulated impairment by 15,000. Therefore, the asset held for sale will be measured at 230,000 and the impairment loss of 15,000 will be recorded in P&L. Next is when the fair value less cost to sell is 240,000 and the carrying amount is 230,000. The carrying amount is lower than the fair value less cost to sell, so no adjustment need to be made. But however, Ray already done an impairment before, which is on 1st December X4, so reversal of impairment can be made. Difference is only 10,000, so reversal of impairment for 10,000 should be made. So we need to debit accumulated impairment by 10,000 and credit impairment gain by 10,000. Therefore, the asset held for sale will be measured at 240,000 and impairment gain of 10,000 will be recorded in P&L. The last one is when the fair value less cost to sell is 255,000 and the carrying amount is 230,000. Same as the previous one, where the carrying amount is still lower than the fair value less cost to sell, and reversal of impairment also can be made. However, the difference is 25,000, which is more than the amount that we have impaired before. It only can be reversed maximum for 50,000. Therefore, they need to debit accumulated impairment for only 15,000 and credit impairment gain for 15,000. Therefore, the asset held for sale will be measured at 245,000 and the impairment gain of 50,000 will be recorded in P&L. So that's all from me. Thank you.
Okay, hi. So there is another example from Alia's explanation just now, which is about subsequent measurement and reversal of impairment losses. So here is the example, which is example 9. In this example, LMN had a piece of land of carrying value of 2 million. It was previously revalued and the surplus on revaluation was 250,000. On 15 September X4, the land was classified as held for sale and its fair value was 1.8 million. On 1st March X5, the fair value of the land increased to 1.95 million and the asset continued to be classified as held for sale. The financial year end is 31st December. Required, show how the impairment loss and its reversal will be accounted for. So here is the solution. Okay, based on this example, our carrying value is 2 million, but it was previously revalued and there is surplus on revaluation of 250,000. So we want to know the amount before it was revalued. The amount will be 2 million minus 250,000, which we will get 1.75 million. So from 1.75 million to 2 million, there is surplus on revaluation of 250,000. So our journal entry will be like this. We will increase our land by 250,000 and we will have revaluation reserve account of 250,000. Okay, back on the question. On 15 September X4, the land was classified as held for sale and its fair value was 1.8 million. So on this day, our carrying value is 2 million and our fair value is 1.8 million. It's supposed to have impairment loss of 200,000 because the carrying value is greater than fair value. But in this case, since we have balance of 250,000 in the revaluation reserve, the loss will be written off against the balance in the revaluation reserve. So no impairment loss shall go to income statement. So for the journal entry, the revaluation reserve and land will be reduced by 200,000. So now the balance for revaluation reserve will be only 50,000 because 250,000 minus 200,000 and we will get 50,000. Okay, back on the question. On 1st March S5, the fair value of the land increased to 1.95 million. Okay, so from 1.8 million to 1.95 million, there is a gain on revaluation of 150,000. So for the journal entry, the land and the revaluation reserve account will be increased by 150,000. So now the balance of revaluation reserve will be 200,000. 200,000 come from 150 here plus the balance on this date. So now our new balance will be 200,000. Okay, for the next new subtopic is depreciation. So an entity shall not depreciate a non-current asset while it is classified as held for sale. This is because the asset is not being used anymore. So there is an example for this depreciation, which is example 10. XYZ purchased a building on 1st January X1 for 500,000. The useful life was estimated to be 20 years and the residual value was nil. On 1st July X5, the building was classified as held for sale and the fair value less cost to sale was 300,000. Required, discuss the accounting treatment of the building. So here is the timeline. On 1st January X1, the building was being purchased and on 1st July X5, the building was classified as held for sale. So it means that the building only being used for 4 years and 6 months. So first of all, we need to calculate the depreciation. In this example, we will use the straight line method. So for X1 to X4, our depreciation will be 25,000 for each year. But for X5, the depreciation will be 12,500. This is because the building only being used for 6 months. So we need to multiply by 6/12. So after the cost minus the accumulated depreciation, our carrying value will be 387 and 500. So for the next step, we need to choose the lower amount of carrying value and fair value less cost to sale. So the lower amount will be the fair value less cost to sale, which is 300,000. Okay, when the carrying value is greater than fair value less cost to sale, there will be impairment of loss. So to calculate the impairment of loss, the carrying value will minus the fair value less cost to sale, and we get 87,500. So here is our journal entry: debit non-current asset held for sale, debit impairment loss, credit building. Okay, for extract of P&L and balance sheet, the depreciation and impairment loss will recognize under profit and loss statement, while non-current asset held for sale will recognize under balance sheet. Okay, for depreciation, the amount will be only 12,500. This is because on 1st July X5, it already been classified as held for sale. So it means that the building will not use anymore after 1st July X5. So the depreciation only will be charged for the first 6 months. So the amount will be 12,500. So for the next presentation, I will pass to Aina Fakira.
So this is the continuation part for measurement. If there is a change of plan, if the asset is being reclassified as non-current asset, which is not held for sale, therefore it will be measured at lower of carrying amount of asset before it was classified as held for sale, adjusted for depreciation, and recoverable amount at date of reclassification. So recoverable amount is a higher value of value in use and fair value less cost to sale. So let me show some example on how change of plan, on how this method can be applied. So example 14, an entity acquired a plant for Rm 1 million on 1 January X1. The economic useful life was determined to be 10 years with no residual value. On 1 October X4, the plant was classified as held for sale and the fair value less cost to sale was Rm 600,000. On 1 July X5, the plant did not meet the criteria to be classified as held for sale. Its value in use 10 was calculated to be 700,000 and fair value less cost to sell 575,000. Required show how the entity should account for the plant. So let's say if the asset is classified as held for sale, therefore it will be measured at lower of carrying amount and fair value less cost to sell. Fair value less cost to sell was Rm 600,000. But if it's being reclassified, it will be measured at lower of carrying amount before classified as held for sale and recoverable amount. So this is the working solution. On 1 October X4, plant was classified as held for sale. As per mentioned, plant was classified as held for sale. Therefore, the carrying value, how to calculate? Original cost minus depreciation cost each year. So depreciation cost 1 million divided by 10 years equal to 100,000. So total years, which have 1 January till 1 October X4, which is 45 months, divided by 12 months, which is 3.75 years. So the carrying amount is 1 million minus 100,000 times by 3.75 equal to 625,000. So this is the carrying value amount, and the fair value amount less cost to sell, as per stated, 600,000. So this is how to classify the asset on 1 October X4. Okay, so we will take lower of carrying value and fair value less cost to sell, which is 600,000. Okay, next. On 1 July X5, the plant did not meet the criteria of held for sale. Therefore, it should account as follows. So if the plant did not meet the criteria of held for sale, we will be measured at lower of carrying amount of asset before it was classified as held for sale, and recoverable amount at date of reclassification. So this, how to calculate carrying value, original cost minus depreciation cost each year, 1 million over 10, which is 100,000. We get the depreciation cost. Total years, 1 January X1 till 30 June X5, which is total for 54 months, over 12, which is 4.5 years. So the carrying amount, 1 million minus 100,000 times 4.5, which is 550,000. So the recoverable amount is the higher of value in use and fair value less cost to sell. So for value in use, we have here value in use 700,000 and fair value less cost to sell 575,000. So the recoverable amount, higher of value in use and fair value less cost to sell. Value in use RM 700,000. Fair value less cost to sell 575,000. So we take higher values, which is the recoverable amount here is 700,000. So since the plant did not meet the criteria of held for sale, therefore it should be accounted as non-current asset under MFRS 116 plant property and equipment. So it will be measured at 550,000 as carrying value because it's lower than recoverable amount, and it will continue to be depreciated.
Okay, I'm going to proceed presenting about presentation of non-current asset or disposal group classified as held for sale. First, non-current asset held for sale, either individual asset or asset of a disposal group, must be presented separately from other assets in the statement of financial position. Also, the liability of a disposal group must be presented separately from other liabilities. But both of them, asset and liability of a disposal group, cannot be offset or presented as a single item. Major classes of asset and liability can be disclosed either on the face of the statement of financial position or in the notes, except for newly acquired subsidiary, where a parent do not require to present separately the major classes of asset and liabilities that meets the criteria to be classified as held for sale. Lastly, entity do not have to reclassify the non-current asset or disposal group in the prior year's statement of financial position to reflect the current classification. So let's look some illustration here. The first illustration is about a single asset. As all of you can see on the screen, if it is a single asset, the non-current asset held for sale is presented separately than other asset, and it is stated under current asset. Why? Because it is no longer considered as non-current asset. Next, for illustration 2 is about disposal group. The entity has revalued a non-current asset held for sale. The surplus remaining in the reserve is 550,000. The disposal group consists of plant property and equipment, inventory, and liabilities. So, as for disposal group, the entity needs to sum up all the assets that will be disposed along with related liabilities. So here, we sum out plant property and equipment with inventory and get a total of 1,440,000. And for the presentation of disposal group in the statement of financial position, the non-current asset held for sale and liabilities are presented separately from other assets and liabilities without offsetting or combining them as a single item. And for the reserve relating to NCA held for sale is presented under equity. That's all from us.
Thank you.